The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague. He's not invited to Taylor Swift's wedding, but he's always welcome here. It's Anthony Macdonald. How are you, Anthony?
I'll always be here, James. Chanticleer players got to play.
Very nice. Well, this week we look at how your super fund fared through the drama of the 2026 financial year. We explained why the end of what's been called Australia's housing Ponzi scheme matters more than just to house prices. And yes, we'll preview the celebrity wedding of the year. But first, Anthony, it's been a massive week for the great white whale of Australian capital markets, the data centre hopeful Firmus, which is absolutely steaming towards a share market float at the end of the year after signing a new deal with chipmaker Nvidia to build a massive data centre in all places on an island off Indonesia. Now, Anthony, this all sounds very exciting and maybe even a little bit mysterious, but it's the numbers that remain eye-watering around this business. They're talking about annual revenue commitments of $30 billion by the end of this year when they might float. That's not bad for a business that doesn't run a data centre of any size yet, is it?
Big numbers, James. Firmus has always talked a big game. And the game it's talking just seems to get bigger and bigger and bigger. And, you know, most of us just get up in the morning, put one foot in front of the other. These guys are just shooting from the moon from the get-go. So, yeah, that annual revenue, you know, they're talking about maybe trying to have locked-in revenue of $25 to $30 billion a year, right? It's huge, but it's all based on the contracts. And they just did this massive one in Indonesia. Like you said, it will come online from next year, about US $5 billion a year. Revenue could end up being a little bit more if Firmus can on-sell some of this compute to someone else. I mean, it's got this data center about to go live in Melbourne, the BK2. It's got the first purpose-built AI factory in Launceston. There's probably a couple of $1 billion of revenue between them there. Yep. It's targeting a few more though, James. Like the huge one is in South Australia. It signed a power deal around it early this week, 600 megawatts. I mean, that's 60% bigger than what's in Indonesia there. I mean, it's also looking in New South Wales, elsewhere in Victoria. Let's see where it gets to. I mean, that $30 billion revenue number, it's a stretch, I know. And I know I wrote it earlier this week in a story, and I'm not backing away from it. It won't be in its first year, but it's just how big it's trying to get, right? Like it's how ambitious it's trying to be in its pipeline and what it's doing. But like I said, all the numbers around this are big. Like that contract in Indonesia, US $25 billion of revenue for 5 or 6 years. It's amazing. And that revenue is supposed to be from NVIDIA. It'd be great to see the actual details of that contract because you've got to be a bit skeptical about it just given the size of it. Yep. But the data center they're fitting out there will require $20 billion or so in CapEx, James. Like that's up front. That's to buy all the computers and the equipment. You think it'll be 80 or 90% debt funded. So, you know, it's probably a $16 or $18 billion loan in that. How would you like to be on the hook for that sort of money?
Well, but in a way, Anthony, the numbers we're seeing out of Firmus, they match the numbers we're seeing out of this whole AI boom, don't they? Like everything is just bigger with this stuff. You know, they're not spending $1 billion a year, the AI hyperscalers. It's $1 trillion a year. Like everything is bigger in AI.
Absolutely. And it's not just Firmus shareholders now on the hook or lining up with this. Like we saw with the South Australia energy contract this week, James, it's now governments and energy systems that are putting their faith in these sorts of companies to come in and bankroll the energy generation and storage that we're going to need to transition the grid, which is what we've been waiting for. But until it all plays out, I'm not sure we're going to properly believe all the numbers are there. But James, Firmus' big customer is Meta Platforms, which literally holds a right to own just about everything it could build here in its wildest dreams for the next few years anyway. I mean, Meta owns Facebook and Instagram. It had some big news this week with reports saying it might set up a new business to sell excess computing power. That would be a bit of a pivot. But where do you think that fits into the AI story?
It's a strange one, Anthony, because Meta and basically every other AI company in the world has been telling us that there's not enough computing power in the world. And that's why we need all these data centers and we need them tomorrow. Can we just get building? And then all of a sudden we get this report from Bloomberg, very well sourced, I've got to say, not confirmed or denied by Meta, that says, we might set up a cloud computing business to sell our excess capacity. And I think everyone in the market went, hang on, there's excess capacity? You've been telling us for the last year and a half that there's not enough capacity and now there's excess capacity. So that did send a bit of a ripple through markets. We saw the chip makers who, do well when there's AI infrastructure investment. We saw them sell off. We saw in Australia some of the companies that are helping to fit out data centres and provide electricity and electrical equipment, they fell as well. I wonder what it means for Firmus. I think there's two ways you can look at this. One is that, well, Meta Platforms is backing away a bit from the AI boom. They might not need as much capacity as they thought. Or the alternative is Meta needs as much capacity as it can get because it wants to start a whole new business. And so it'll take absolutely everything Firmus can get and more and go and resell this. So either way, I think it's an interesting little twist in the AI story. Anthony, had Firmus been trying to list this week or trying to do a big debt deal this week, this story might have hurt sentiment a little bit. And just to me, that says, between now and the end of the year, when Firmus hopes to list, gosh, we're going to have a few ups and downs and a bit of a roller coaster ride in sentiment as we get towards this deal. So the Firmus team will have to be sort of pretty steadfast to keep marching through that, I guess.
Yeah, there's some love story between Firmus and Meta, as our mate Tate would say, James. Maybe this contract explains why it's gone so long, Firmus, and why it's trying to line up so much compute capacity. I don't know. Let's see where it goes.
I'm starting to wish I never made this Taylor Swift joke at the top of the episode, by the way.
And James, it's been a tough week for our second biggest supermarket chain, Coles. Its shares will end the week down about 5% after two bits of news. Can we start with the big deal or the potential big deal? And that's Coles possibly buying a vet and pet food business called Green Cross. Why didn't investors like this idea? I mean, Woolies owns something similar. Is it such a bad thing?
Poor old Fido. He's been sent to the Coles doghouse. Look, I think there's a couple of things that investors didn't like about this. One, Coles under Leah Weckett, the CEO, has been laser focused on supermarkets and their execution in supermarkets has been brilliant. And basically investors don't want anything to disrupt that. And they would see the acquisition of Green Cross as a potential distraction or disruption to this great supermarkets business that Leah Weckett's been building. So that's part of the reason investors don't like it. The other is, of course, that Green Cross is owned by private equity. Investors don't like when companies buy stuff from private equity. They think that the private equity firms squeezed all the good juice out of this business, grown it as much as it'll grow, and what they're selling is a business that's maybe still got a bit of growth left in it, but not as much as it once did. So investors just reacted really quickly to this. I think you caught a bit of it was almost fury from some fund managers at the very idea that Coles would sort of step out of its comfort zone with this deal. And I think that Woolworths, as you say, they bought a business called Petstock a few years ago. It's an acquisition that hasn't set the world on fire. The ACCC didn't like the deal and Woolworths had to sort of do a lot of gymnastics to get it over the line. It just hasn't worked. That was one part of the bad news for Coles. The other part was something you wrote about, Anthony. The competition watchdog has blocked it from buying the land to build another supermarket in the West Australian mining town of Kalgoorlie. Now, one supermarket in one town doesn't get to go ahead. Doesn't feel like the end of the world, Anthony, but why was it such a blow for Coles?
Well, it's a blow because the competition watchdog only just got those powers to give it the right to scrutinise every big lease that Coles signs. And by lease, I mean, supermarket-sized lease.
Yeah.
And you might remember the sort of fury around Coles and Woolies and the market power and pricing and all that from a year or two ago in the cost of living crisis.
Totally.
Part of that was accusations. They just kept buying and building these stores, buying and building land, sort of like creeping their way to this market power to the point where they're by far the two biggest grocery sellers in the country. Well, James, like the first contentious one they put in front of the ACCC's knocked it on the head, and it's a lease for a new shopping centre in Kalgoorlie Boulder, adjacent to the airport for anyone out there in the goldfields and knows the town well. Coles wanted to put a 2,800 square metre supermarket and liquor land there. Apparently that's sort of like a normal-sized shopping centre. I mean, it argued it would be good for competition, another player in the market, good for shoppers, better prices, better services, all that. But the ACCC said no, no way. It might be good in the near term for you, Coles, to open this store. It might be good in the near term for the competition. But it said it would likely squeeze out one of the other independent supermarket operators and leave the town even more dominated by Woolworths and Coles. And how it got to that decision was really interesting. I mean, that's actually quite basic as well. You just look at who's there in the town. There's four big supermarkets, Woolworths, Coles and IGA, and a WA operator called Spudfresh. And you just look at the economics around it, consider the population growth, consider how much demand there's going to be for groceries. So it ended up with the decision He's trying to stop competition in the near term or reduce competition in the near term because I think it's better for competition in the long term. So, Coles is going to have to think hard about whether to challenge this one, James, because as you say, it is just one supermarket in Kalgoorlie. But is it indicative of a whole bigger wave that's coming down on them?
Yeah, tough decision for Coles, so we'll see how they bounce back next week. All right, Anthony, let's move to our first big topic of the week. And the start of the new financial year on July 1 means that tens of millions of Australians will soon be poring over their superannuation returns for the 2025-2026 year. And those will capture a pretty extraordinary period on markets. Now, our biggest super fund, Australian Super, has delivered a return for the year of 9.8% from its balanced My Super option and 11.6% from its high growth option, while our second biggest fund, Australian Retirement Trust, delivered a 9.2% return from its My Super option, which also serves as its high growth option. Now, Anthony, that's not too bad given most super funds try to beat inflation plus a bit more. At AusSuper, for example, their target's inflation plus 3.8% after taxes, fees and costs, which probably makes their target somewhere around 7.5%. They've comfortably beaten that. And they've also comfortably beaten the old ASX 200, which, Anthony, had a pretty tough year and delivered just 2.77%. But the MSCI World Index, which gathers all the stock markets from around the world into one basket, it delivered a 22% return as the AI trade ran hot. Anthony, 22% versus about 9%. Should we really be happy with what we've got out of our super funds?
Look, 9% is a decent year on paper, James. Yes. Like if you offered me 9% a year for the rest of my life, I'd take it.
Yeah,
just think, put yourself in a superannuant's shoes. I don't know, if you've got $200,000 in your super, it's compounding at 9% a year. In 30 years' time, that 200K is worth about 2.7 mil, right? Like 9% a year is juicy. This year's 9%, I'd say it's not as good as 9% this time a decade ago because inflation's running hot.
Yeah.
You just talked about the inflation plus targets these funds have. I mean, there's no official data on inflation yet, but the RBA expects CPI for the year to June 30 to be 4.8%. 9%'s, 320 basis points above inflation. That's good, but it's not as good as when inflation was at 1 or 1.5%. You're getting 9% and you were absolutely creaming it. So I'd give the sector a pass mark. I mean, that 9% really came from equities this year. Yep. And in hindsight, if the super funds could have, they should have owned a lot more equities, right? Like just get as close as you can to that MSCI World's 22% index and you're laughing. Like that 22%, it's an absolutely staggering number. I mean, our big funds tend to have about 60% of their portfolio in equities. I mean, so the MSCI World's doing a lot of lifting for you if you're investing in around that. And why didn't our funds get that much? I mean, clearly they don't own enough of the hot stuff.
Yeah.
Too many Australian shares, not enough of the chip makers, the big contributors in the US market with the mega cap US tech stocks riding the AI optimism wave, your Nvidias and the like. Japanese equities up 70%, needed more of those. So the super funds are slow old learners, James, and we are coming across that more and more in these times. They are conservative. They are very conscious that these are members' retirement savings, their life savings, and they don't want to blow it up. So they're not all chips in these bull markets, which they reckon will protect them in the bear markets. Let's just see what happens. But right now, we're really in these bull markets. We've had, 3 or 4 years of them. Super funds aren't going anywhere near where the listed equity markets have in that time, but they satisfy themselves that they're nice and diversified. James, we just got off the phone with Sean Manuel, the Chief Investment Officer of Australian Super. I only started there in the job this week. What was your big takeaway from him about the year that's just been and then what's coming?
Well, I thought he had a great line that goes to what you're just talking about, Anthony. He described markets at the moment. They're in the grip of what he called rational exuberance. The AI trade's running hot, and so it should be. It's a very exciting thing. There's a lot of capital going into it. It is pumping up returns. What he is concerned about is when that rational exuberance tips over into irrational exuberance, and we get the possibility that this bubble or this bull run ends. And we see a fair bit of risk of some negative returns for share markets. So he's very mindful of that. As you just said, could the super funds have stretched themselves to get a higher return? Yes. Would that have meant that they're taking on more risk? And as you say, putting people's retirement savings at a bit of risk? Also, yes, and I think that's really what he's thinking very hard about. So that's the balance. So you described AusSuper as being marginally overweight international equities, which sounds sort of like where you want to be. You got plenty of them, but you don't have too many that you're going to be caught out if this all comes a cropper. As you say, he's 2 days into the job as CIO of AusSuper, so he's getting his feet under the desk. And he won't have much of a honeymoon period, Anthony, because if there's one thing we've seen from the last 12 months, and the last 6 months particularly, the markets are just throwing so many different storylines at investors, and you've got to be able to ride those bumps and see through it. So it's going to be pretty full on, I think. Anthony, you've written a lot about the performance test that super funds have to meet. Now, this is the test that the prudential regulator in Australia runs. The idea of it is that it tries to name and shame any super fund that badly lags behind the ASX. Now, lots of people think this performance test is actually distorting our market, in that basically all the super funds are hugging the index and capital flows are going in great big dollops to our biggest companies, while smaller companies, well, sort of get starved of capital. The tests are under review. You've been writing a bit about how this review is going to play out. What do you think is going to change?
Written a lot, yes. I'll take that as a comment. James, probably too much for our dear audience.
I think it's a big topic. It's a huge topic.
No, we talk a lot about the structural changes in the Australian equities market. I mean, that's one of the bread and butter bits of our job, right? That's where the sort of the corporate world meets the financial markets. And I think that's our role to pick into that. And things have been very unusual in Australian shares, like unprecedented, unusual in recent years. You know, your CBA share price getting to $160 plus, the IPO market very slow, the 40% drop in share prices on earning misses and results days, the lack of liquidity through the trading day, the hectic trading that happens around index rebalances, the fact that 30 to 40% or more of the shares can go through in a 10-minute match at the end of the day when the passive funds trade. I mean, all that tells you that there's structurally big changes. We're looking into why. I mean, the performance test is part of that. Because likewise, you can look at capital allocation more broadly, think about startup funding, infrastructure investment, property investment. Yeah. I can make the case to you that the performance test is distorting those investment decisions as well. And that's because the test sort of splits down a fund's performance by asset class. So in equities, infrastructure, or fixed income or whatever, it says take that little allocation you've got and you've got to compare it to the benchmark in that sector. So it encourages you to basically hug the benchmark, and the consequences for failing the test are massive, right? So
existential.
There's very, very little incentive to actually take risk, to back what you may truly believe in, and all the incentive just to be close to the benchmark. So anyway, James, I know I bore people, but this is distorting the way the capital is allocated. I feel it quite strongly.
Absolutely.
Just look at your pay this week, James, and 12% of it's going to go into super, right? About a quarter of that will be in Australian shares, and a quarter of that again goes into BHP and CBA. So if you think about it, about 6 cents in the dollar goes into CBA and BHP. I mean, is that good for the country? I mean, these are two well-run companies, but they're big, efficient, mature businesses. And you've got this supposedly really long-term time frame on your super. I mean, as you know, you're going to be working for the next 50 years before you retire. So, there's the chance to actually do something with that money that doesn't require liquidity and thinking too much about it for long term. Is putting it into BHP and CBA, the best way to do it.
Great way to frame it.
So anyway, that's what it kind of comes down to. I mean, is it going to change? I mean, the Treasurer, Jim Chalmers, has been talking about it enough, and they're doing this review now. They're taking submissions on it. I think yes is the short answer, James. The idea of a performance test itself is fantastic. I mean, so many people, 12% of their wages are going into super. These people may not understand financial markets, how it's being invested, yet they have to trust that 12% is being looked after properly. I mean, it is so crucial that gets looked after. The idea that there's going to be a performance test, there should be and there will be. It's just the structure, how exactly funds are measured. I think there'll be changes, James. I mean, unless I'm just listening to completely the wrong people and I'm hearing both sides of the debate, but I think it'd be good for Australia if there is change. I mean, I think it has contributed to the malaise in Australia, in the economy, in the way that capital is being allocated. I mean, I see it. It's material. And I talk about equities all the time. In the infrastructure benchmark, there's lots of airports. So at the moment, as soon as an airport comes up for sale, someone snaps it up straight away. Yeah. But in the growthy sort of infrastructure that we may need, anything around the energy transition or networks or whatever, not so much in the benchmark, people don't want to put money in it. Why? Because of the performance test. Yeah. So it does make a difference.
Absolutely, yeah. And I think you've done a great job writing about it. And that breakdown of where $1 of everyone's pay is going is remarkable.
Yeah, so James, you've been lucky enough to talk to Sean, you've talked to Seabus, a few other funds. I mean, put it all together, what are the big factors that are going to shape super returns in the year ahead?
Well, I think from their perspective, there's two. AI, where does this AI boom go? Can the AI capex investment boom continue, or does it all come a cropper? That's number one. And the other is interest rates and inflation. To come back to your point that 9% today doesn't look like 9% 5 years ago because inflation is running high. That is poison for super fund returns, and so super funds are going to have to make a decision. How far out the risk curve do they want to go? How much more risk do they want to take to try and beat inflation? And that's going to be a really tough question for them. Just one other thing I'd throw up, Anthony. This week I've been reading, and I've written a piece today about how much retail investors in America are pushing around indexes.
Yeah.
Like, there has been a stunning increase that the bottom 50% of American households have never had more money invested in share markets. They're not just investing in normal ways, they're investing via leveraged ETFs, which sort of juice up their returns, but also juice up the risk they're taking. They're investing via options, which again are hugely risky, basically like gambling. They're using margin lending to juice their returns. So this has become the real force in deciding where American share markets go. As we've just said, our super returns are increasingly reliant on what happens on American share markets. So I think that's a factor to watch too, a bit of an unusual one. Anthony, what else? What have I missed?
Well, just quickly, what you said on the retail investors there, James, like these stories, you wrote one up this week about Donald Trump and the way he invests. And, there's similar ones around about Nancy Pelosi. Like, they are minting it. Right. Yeah. So why wouldn't everyday people, they see that? Why wouldn't they try and get in on it? Like it's quite amazing. Yeah. I mean, my list would be similar to yours. Inflation, the big anti-hero. Once again, Tay-Tay. I'd add to your list just AUKUS. And the way that AUKUS changed the capital flows. And this, relevant for us here in Australia. Okay. So much of what I'm writing about at the moment and thinking about, and particularly in this deal sort of landscape and the way things are funded, the mergers, all that sort of stuff, so much of it at the moment is sort of these AUKUS-based relationships, picking the right partner, strategic alliance, all that sort of stuff. It is very, very material. It's the reason why the big tech companies in the US want to set up their data centers here in Australia. I mean, every second deal I write about, it's this sort of Australia-US strategic agreement sort of stuff. So, I mean, that's the one that's come up in the past year or two that wasn't there before. And for me, it's getting stronger, not weaker, particularly under this Trump era. Well
said, Anthony. I think that's a really good point. I hadn't thought of it as in the AUKUS frame before, but you're right. It's about more than submarines.
All right, James, the end of the financial year is a good moment to look back at what's happened in all sorts of asset classes, and none matters more in Australia than housing. The latest numbers tell us a pretty mixed picture. The national median house price rose 7.3% in the year to June 30 to $978,000. But in the last 3 months, prices have fallen 0.7%, and in Sydney and Melbourne, they are down 3.2% and 2.6% respectively. They've been smoked. James, we talked in the last few weeks about the fact a housing correction is underway thanks to the rises in interest rates we've had and the tax changes the government announced in the budget. So these numbers do not come as a surprise, but they come after 5 years of phenomenal growth. This week, you wrote that the end of the housing market Ponzi scheme could create some surprises for Australians. What did you mean by that?
Anthony, I borrowed that phrase, housing Ponzi, from a guy called Martin Conlon, who is the head of Australian equities at Schroders. Anthony, I reckon you might say he's Papa Bear to my baby bear. He's pretty sceptical about the world and how it's developed. For a while, he's had an argument that basically Australia's fallen into the trap of pumping more and more debt into housing, and we've convinced ourselves that that's actually economic progress because all our house prices are going up and we all feel wealthier. And he says that's absolute garbage. All we've done is create a big pile of debt and inflated bank stocks. And now we are seeing that come apart. So we're seeing some sharp moves downwards in house prices. We're seeing some big falls in housing loan applications. So I think there's a lot more to come here. The housing market's going to soften materially. As you just said, that's fine. We've had a huge, incredible run in housing. So a bit of softness is probably a good thing, particularly to help first home buyers get into the market. But Conlon's point is that there are some flow-on effects from that we don't think about. Just think, for example, how many jobs are attached to housing prices going up. Think of all the mortgage brokers. Think of all the property valuation people, all the builders. When someone buys a new investment property, their job's to go and renovate it. Think of all the property managers. There's a lot tied up in that housing edifice. And if that really starts to crumble, Conlon's point is that will have some ramifications. The other point is that asset prices falling off tends to flow through into other parts of the economy. We see this, it's called the wealth effect. When people feel like their wealth's going up due to housing, they spend more. When they feel like their wealth's going down because house prices are coming down, they spend less. And so that's got a second order effect. One other second order effect I'd point out that actually does worry me, that is that we're all trying to increase housing supply, right? We need more houses to make more houses affordable. Falling house prices will hurt supply because developers will look at that and they'll say, hang on, I'm not going to be able to sell this new block of flats that I'm going to put up. I'll just have to hold off. And so we will get a fall in construction activity, building approvals. That is a bit of a nasty side effect from this fall in house prices that everybody's happy to live with. But what's interesting, Anthony, is that you're in Sydney, I'm in Melbourne, and that's where the markets are cooling rapidly. But it is a very different story in some other parts of the country, isn't it?
Oh, isn't it what? We have two speeds here, James. It's amazing. Sydney, Melbourne, Canberra going backwards, and enough population in those cities, Sydney and Melbourne in particular, to bring the overall numbers down. But the other markets are strong. Like just in the month of June, this is the worst month for Sydney and Melbourne. Up 1.3% in Brisbane, up 0.7% in Perth, up 0.6% in Hobart, 1.4% in Darwin. Like even on the June quarter basis, all markets were up, except for Melbourne, Sydney and Canberra. On an annual basis, and remember it was pretty hot last year before the rate rises came into the agenda.
Yeah.
Perth on an annual basis is up 23.9%. Darwin, 19.8%. Brisbane, 17.4%. Adelaide, 11.6%.
Yikes.
Regional areas more broadly, 11%. It's only Melbourne and Sydney that are flattish or slightly down. In your case, sorry, James, in Melbourne. We very much got this two-speed housing market. And why? I mean, prices are higher in Melbourne and Sydney to start with. I mean, maybe they went further. They got further to come back. Borrowers are more leveraged. They're more hit by interest rates. Then the budget comes along and we just can't shake it off.
Very nice.
And then you've got the economies as well. They're very different. So you've got the services in the city. You've got the real economies, mining, agriculture, outside of the biggest cities.
Yep.
We had the trade numbers out this week as well, James. And while exports were smacked in the month of May, mostly because the gold price is down and the energy exports aren't worth as much as what they were because the oil prices come down, they're still very strong. Up 4.5% for the year for the 12 months to May. And that's the resources sector doing the heavy lifting there, James. I mean, and that's not really a Sydney or a Melbourne or a Canberra story, right? That's Perth, that's Brisbane, that's the regional markets. So I think it shows, like we used to talk all the time about the two-speed economy, and I mean, that's kind of gone away. But the housing market's definitely two-speed. And surely underneath that, there's a two-speed economy story as well.
Agree.
In my opinion. James, you spoke briefly before about the wealth effect, and I wanted to bring in a question here from Christian in Victoria. He's a student studying economics, and he heard us talking about the wealth effect in recent episodes and says he doesn't really understand how reliant Australians are on a housing market as an asset class, or frankly, what a decreasing housing price means for the majority of Australians, other than it might be good for younger people to try and crack into the market. But what proportion of households have residential property as their largest asset? And do Australians need to change their view about housing in Australia from the 1950s single standing dwelling house with two kids to account for a more modern world? Like, what do you think?
Oh, two great questions from Christian.
Yeah.
Now, just on this idea of how important is housing to Australian households, well, housing accounts for about 65 to 70% of the average Australian household's total wealth.
Mm-hmm.
So we're not quite chips in on housing. That's probably thanks to the superannuation sector, but we're not too far off it, Christian. So that is why we get this wealth effect. And the RBA has studied this and been able to show it, that when Australians see house prices going up and they feel richer, even if it's only on paper, they are more willing to spend on all sorts of things. And the reverse happens. When house prices come down, there's a reverse wealth effect where consumption can dry up. Now, it's not a major, huge driving force. a much more important driving force is employment. If people have got a job, that's what drives spending, and the opposite. But it is, this wealth effect is at the margins a pretty important driver of growth or handbrake on growth, depending on where the market's at. So yes, I think that's why we see so many stories. We've seen them this week. So many stories about housing in the media because people think about it. They talk about it. It is the ultimate barbecue stoppers. Now, Christian's got a second question. Should we be thinking differently about housing in this age than back in the 1950s? And the answer, of course, is yes. Our household makeup has changed. We have smaller households. We have, more divorced couples. We have more people who are living longer into their life. So that changes the makeup of households as well. So we do need to think differently about households. I think we have. Do we need to do that more? Could we, for example, encourage more downsizing to free up more homes for families? Yeah, there's all sorts of things like that have been suggested, and we should be looking at them. And maybe this sort of great housing reset, Anthony, could be a time to do that. But what I see is the debate goes back to house prices so quickly. Anthony, we saw this week Liberal leader Angus Taylor, he tried to wedge Prime Minister Anthony Albanese by asking him to guarantee that house prices won't keep falling. Now, I know this is a stunt, clearly, and it didn't really work, I've got to say, but it does show you how hot the political element remains here, doesn't it?
Oh, for sure, James. Angus Tate. It was a good oppositioning from him. He did what you got to do. You just got to try and score some points where you can, and obvious place to attack. It's just this scaremongering. Lots of homeowners out there, they don't want their values going down, even if they've got no intention of selling and they worry about their, kids or grandkids locked out of the market. I mean, the PM, he sidestepped it, doesn't want to go there.
Yeah.
I mean, you can guarantee that. It's a stunt of a question. If Albanese wanted them to stop falling, he could do it in an instant. I'm not sure that would be responsible, and it would cut against the whole budget rhetoric, which is only less than 2 months old now, that about having a fair go, or as he said, a fair crack for young people to get into the market.
Yes. He loves that one.
Yeah, I mean, politics here, it's burning red hot.
Yeah.
If we're approaching the next election, James, and house prices are going backwards in Sydney and Melbourne at 3.2 and 2.6% a month still, I mean, good night, nurse, for the government. It will be absolutely turned over in an instant. I mean, it feels like there's a bit of heat coming out of the market now. The government's quietly happy to see that, just knock the top off it. But yeah, I mean, 2 and 3% month-on-month slides. Keep that up and the whole thing will be turned upside down.
Funny you should say that, Anthony. We've got a state election here in Victoria in November. This week we've seen a lot of focus has been on a very different type of building, the construction sector and the corruption in that sector, which has turned the heat up incredibly high on Premier Jacinta Allen, who's come out today in the Age newspaper and apologised for that corruption, which is a sort of a big moment. But I do wonder if you're right, if house prices become a big issue for the state Labor government here as well. It'd be fascinating to see. So a lot to play out in housing, and to Christian, we'll stay on the case for you because it really is top of mind for Australians. All right, Anthony, we'll come back after the break. If you haven't had enough Taylor Swift jokes yet, we've got a few more. We'll preview the wedding of the century. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, we've been talking about it all episode. Taylor Swift ties the knot this Saturday with Travis Kelce, the former American football player, at that very intimate venue, Madison Square Garden in New York.
Wow.
Lots of intrigue, lots of secrecy, lots of privacy around this wedding, Anthony. But what I'm watching for is whether Tay-Tay can monetize this. Does she sell the rights? Is there a soundtrack or at least a Spotify playlist? Now, she doesn't need the money. I was looking this week. Forbes says she's worth a touch over $3 billion at the moment.
Solid.
But she's an entertainer. Now, are you going to be glued to this, Anthony, or will you just, I can't believe I'm going to say this, shake it off?
Look, prior to you mentioning it, James, I didn't even know she was getting married this weekend, so I got no idea. I mean, my Taylor Swift knowledge is limited to what my beautiful 7-year-old Helen says and always wanting her songs and, dance around the lounge room. But good luck to Taylor and Travis Kelce. Hope they have a great future together.
Yeah, maybe we can get them a subscription to the Chanticleer podcast as a gift to keep them.
They'd have one.
Yeah, probably.
Yeah.
All right, the last few weeks we've done a Socceroos prediction on the Chanticleer podcast. The nation wakes up at 4 a.m. on Saturday, Anthony, as the Socceroos do battle with Egypt. I need a prediction.
Oh, look, I've been down on them the first 3 games. I mean, the first game from them was great. Second one, not great. Third one, they did what they had to do. I'm confident this week, James.
Ooh, okay.
Yeah, let's win a knockout game. That doesn't happen every World Cup.
Yep.
I'll be getting up early, so can't wait.
Yeah, 1-0 Socceroos on to the next round. Go, boys.
Mm-hmm.
And Anthony, back to more serious matters. It's a bit quieter on the news front next week with school holidays starting in Sydney and running on in Melbourne. But next week we've got a speech by Sarah Hunter, the Assistant Governor of Economics at the RBA, and she's going to be speaking in Canberra at the Australian Conference of Economists. I would suggest, Anthony, there'll have to be something about the RBA's inflation thinking here, won't there? I mean, we're going to see a bit of communication about what the RBA's thinking about the world generally, but this would feel like a decent time for the RBA to maybe nudge expectations one way or the other. Maybe?
Few closet Tay-Tay fans, I reckon, at the Australian Conference of Economists, James. Yeah, no, these speeches, they're worth tuning into. There was one this week from another Assistant Governor, Christopher Kent, that caught my eye, James. And what he was actually there to talk about was one thing, but what the market wants to hear is what they actually think about the data that's coming out on inflation and jobs. And, I mean, he gave a little bit away late in the speech. He talked about the intertemporal effects of rate rises, and that's exactly what you were talking about before, where, rates go up and everyone is less incentivized to consume. It's not just people with borrowings that get slumped with bigger interest payments, but people that don't have borrowings that can put money in the bank, their rates go up. They're encouraged to sort of like pull that money out of the economy, just sit it in the bank. And the spill-on effect of the property prices as well, like you said, how that sort of flows through the economy. Like, it's not just the property prices. It's, your real estate agents have less to do. The conveyancers have less to do. The banks have less to do.
Yeah.
The house painters who normally fix up houses before they get sold have less to do. Like, there's a real knock-on effect. So, no doubt Sarah Hunter will turn up to talk about one thing, and then everyone's just going to pump her about the economy right here, right now, what it means for interest rates.
Yeah, absolutely. I'll be a fascinating listen, I reckon. Well, we love questions here at the Chanticleer podcast. We took one earlier on the wealth effect from Christian, but we got another one from Anton in Victoria. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, there's a widget at the bottom of each Chanticleer article at afr.com that you can use to submit a question too. We'll ask our producer Mandy to do the honours for Anton's question.
Anton says, "Hi Chooks, is the time right for the GST to be increased? If an opposition put together a policy of scrapping the CGT changes, index income brackets and get states to agree to pausing increases in state taxes like payroll tax for a period of, say, 3 to 4 years on the basis that GST is increased, this would help cash-strapped states give wage earners more cash and hopefully restore confidence back into the business sector. Would be very interested to know your thoughts."
That's a fascinating idea. I wonder if this is Anton Chalmers from the one of Jim's relatives sending in. This is a good idea, Anthony, and this is, I think, the most suggested tax reform from economists is an increase to the GST and doing some of those things that Anton talks about. Fixing income tax brackets, getting the states to pause payroll taxes, changing some of the other tax settings, basically using a GST increase to pay for some other reforms, some big reforms. I like the idea, Anton. Anthony, I imagine you like the idea. It's just having the political will to do it, isn't it?
This is a throwback to 12 months ago, this question, James, ahead of the big economics roundtable, and we were going through the changes that Australia could and should and would like to see. And absolutely, I mean, changing the sort of the way that Australia collects its tax income is a big part of changes that, we'd argue would be great. Increasing the GST and taxing consumption more is a big part of that. I mean, it only works if out the other side you're reducing income tax. And in terms of the state taxes, I mean, there's some absolutely shocking ones there. I mean, stamp duty, for example, example, James, like, if the federal government's really serious about creating this sort of housing recycling through the community and getting older people to sell to younger people and make house prices more affordable and everything, I mean, if they knocked off stamp duty or got the states to knock off stamp duty, I mean, that would remove such a huge barrier
Good point.
for people to get out of their homes. And, I see that just in and amongst my family and broader network. It is so hard if you're sitting in a big expensive old family home and you're looking at downsizing, and you might have to pay $100,000, $200,000 stamp duty to buy your place. I mean, you're talking about people who didn't even pay $100,000 or $200,000 for the home they live in. It's such a big barrier. So, Anton, I reckon you're bang on. Unfortunately, though, the government's far enough way through its term this time. We're not going to see it this term. But, let's keep arguing for it.
Yeah, let's keep pushing for it, indeed. Now, Anthony, before we sign off from you, me and Taylor Swift, we've got to say a very fond farewell and heartfelt thanks to our long-time Chanticleer podcast producer, Alex Gow, who is moving to join an AI startup in the US of all places. Now, Alex has been working on this podcast for almost 4 years, and it's fair to say he's been the heart and soul of the show behind the scenes. Not only has he made the show sound brilliant each and every week, but he's constantly strived for ways to make the podcast better. He's challenged our ideas, he's encouraged us, and importantly, he's occasionally put us back in our box when we've needed it. Alex, thank you so much. You've been an integral part of the Chook podcast, and we are heartbroken to see you go. But we're also really excited to see how this next chapter goes, and we hope you remember the little guys when you make your first $1 billion. Anthony, Alex will always be a part of our podcast, of course, as the composer and performer of our wonderful musical theme.
Oh, absolutely. And if anyone's got any more feedback on the theme, send it through. We'll make sure Alex gets it. He loves it when the punters write in on the theme. But yeah, thanks to Alex, big part of the show. Like you said, for nearly 4 years, he precedes me. I mean, he's been great because you and I can get our heads caught up in this financial markets bubble, which is a strange bubble. And, it's a sort of bubble that can skew your thinking, and bombs will start flying in the Middle East, and straight away we're like, oh, oil price, Apple share price, what's it mean? And Alex is, he always brings us back down to planet Earth and get us thinking a little bit more broadly about topics rather than just pretending we're investors and thinking it's all about financial markets. So, all the best to Alex for the future. I mean, AI startup in the US sounds like the place to be, doesn't it, James?
Absolutely. Thanks so much, Alex. We'll really miss you and can't wait to see what you do next. All right, Anthony, thanks for another great episode. And of course, congratulations and best of luck to Taylor and Travis.
Indeed.
We'll see you next week.
See you, James.
If you like the podcast and want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.